All right, everybody, welcome to another episode of The Money Mantra. My name is Chacha, and this is my channel. It's all about mindset and money. In this series called On the Charts, well, it's not called On the Charts, it's just The Money Mantra, but we do focus on trading strategies, trading techniques, especially for beginners, because I think that trading is a skill that everybody should have. People need money to live and sustain themselves, and this is one of the easiest ways that you can actually make money for yourself if you decide to go this route and learn this skill. I know it definitely changed my life, and just the consistency of can like always practicing, always trying to learn something new and figuring out what worked for me because I saw it work for other people. I'm like, I'm not going to give up on this. And I'm happy I didn't do that. So if you're here today and you've traded before, I really commend you for not giving up because it does get rocky, but when it clicks, it clicks. If you've ever started trading and then you learned something new and it just took your trading game to another level, just drop some sevens in the chat, right? Because trading is a complex thing, right? It's a lot going on, but once you understand it, you just have to then know what you're looking for, right? So I like the fact that trading is not gambling. This is a legitimate way to make money. It's a legitimate skill. Some people have been doing this for literally hundreds of years. If you get into the candlestick trading Bible, but using it this way digitally, I think it's only been done since around the 80s. So it's still fairly new, but there's enough information out there for you to understand this and for you to learn a skill and to let it actually change your life. There's so many opportunities and things that you can do with trading, um, outside of just losing money. Like there's so many opportunities, but we'll talk about that another day. So today's class is actually going to be about back testing your strategy. If you've been trading and you have not been profitable, it could be that you're not using your indicators correctly. It could be that you don't understand the indicators that you have. It could be that you're overlooking or missing the signal. You're getting in too early. You're getting in too late. It's a lot of factors, but if you have been like using the same thing and it's not working, you have to ask yourself, have you ever actually stopped to test that thing? The only way we know that something works and something is real and something is true is if we actually test it over and over again to prove the percentage at which you will win. So whatever strategy you're using, I'm just going to teach you my strategy today. It's not anything that's set in stone, but I have used it to be profitable over the last couple of weeks. It's pretty simple. I'm going to be using TradingView, and if you're familiar with this site, you'll know that it has all these different indicators or different things that will tell you something about the price. All of these things that I'm scrolling through will tell you something different about the price. But it's not your job to learn all of them, it's your job to learn which ones work for you. So I think I found something that I really like when it comes to my Forex trading. And I'm going to break that down and how I back tested the strategy to actually prove if it works or not, right? Because if your strategy isn't profitable and you're not using your demo account, you're going to essentially lose money. So for people who are new to trading or just to do a recap, the platform that I'm going to be using to analyze my trades today is called TradingView. You can go to tradingview.com. You can create a free account and test it out for 30 days. Well, you don't even have to create an account to test it, but you can really use it to look at your charts. And if you do choose to pay for it, it is definitely an asset when you start making money. It's going to be really paying for itself. But it's nice because it's for beginners, it's for advanced traders, and it has everything you need to get into these markets, even if it's your first day, and make money. So my chart probably looks a little crazy right now. Let me actually go to something else. I'm going to go to something else, guys. I'm going to AUDJPY. No particular reason. Just to get a naked chart. Oh, actually, let me just do this. Let me just hide it. All right, so first and foremost, the market that we're going to be trading in is the foreign exchange market. Once you go to tradingview.com, when you first log in, they'll actually asks you what type of market do you want to look at. So, for example, if I click on my screen and I start typing a currency pair, you'll see that you can actually look up stocks, futures, forex, crypto, indices, bonds, and all different types of things that people trade and invest in. But today we're going to be looking at forex pairs. A forex pair is just comprised of two currencies, and it's just showing you how what the price is they're buying and selling against each other in the global market. So how people actually analyze this price is by something called support and resistance. So we're going to start there because it's pretty simple. Now I'm going to delete these lines that I have right now just so we can do a brief overview of what that is and why it's important. So when you first log into TradingView, you're going to have a naked screen, right? You're only going to see the candles. You're not going to see this green box. You're not going to see this red box. You're not going to see anything but these candles. And the candles are telling you the price action of the market at whatever interval you choose. We're going to start with 4 hour today. And that just means that a candle is forming every 4 hours. This candle is telling you how high price went for the hour, how low price went for the hour, where price opened at, and where price closed at. Now, those things are important, but it's even more important just to understand visually what the market is doing. Now, an example I'm going to give today, let's just pretend that all of these bars are cars, right? We're going to pretend that all of these bars are cars. And I'm going to put some lines here. These are cars driving on the highway, right? They're all going this way. And we're going to put some bars here. And these bars are going to represent the size of the road, right? It's going to represent the size of the road. Now, if you've ever driven or if you drive, you know sometimes cars tend to drift to the other side of the road, but it's always going to correct itself so that it's actually in a lane and it's not on the shoulder, right? Now, the good thing about this is that when you're looking at the market, if the car, we're going to pretend these are cars, right, is on the shoulder, that's just letting you know it may be a good entry, right? So I just set up 3 lines, and I did this because if these are cars, if the cars come here, you can see that no car is going to swerve all the way into the next lane, right? It's going to correct itself and it's going to come back here. And the same thing here. If this was the other side of the road, they're not going to break the barrier, right? They're going to correct itself and it's going to come back this way. So what you're going to notice when you're looking at any market is that the market is always going to be in between two lanes at any given point in time. And if you can see a clear distinction where there's a lot of action, like if you guys can visually see that there was a lot of price action just in this section. If you guys can see that, just drop a 7 in the chat. All right? Because when you're trading, the main thing that you want to do is create something that's called a price trap. You want to be able to visually look at the market. And I am going to go through why all these boxes are here because these are all the ways these are the back test examples that I have for the class today. But you can go back as far as you want, right? You can create as many levels of support and resistance as you want. But when you're trading and you're looking to set up future trades, you kind of only want to have about this much on the screen, right? At least to start with. You want to create some type of pattern so you can say, okay, is this market, do I see it overall going down? Like, do I see it on a slope like this? Right? Do I see that it's mainly going down? Or do I see that it's on an uptrend like this? Right? You want to be able to look at it in a wider point of view. Now, if you're trading a different style, something called high frequency trading, you're going to be analyzing on very small time frames by the minute. You're going to be taking your profits by the minute. But when you're doing forex trades, the intention is to hold them for a longer period of time. So you have to do your analysis over a longer period of time. So instead of looking at the candles are forming and we tracking the price every 5 minutes. Imagine if this was a bus. If a bus came every 5 minutes, that's pretty frequent. And you would be a little bit more, all right, I'm gonna be a little bit more casual because I know the bus is gonna come. But if the bus is coming every 4 hours, you gonna make sure that you show up when it's time to show up, correct? Drop a 7 in the chat, right? If that makes sense. Let me know if that makes sense, y'all. So when you're trading, the first thing you want to do, especially if you're interested in trading forex, is you want to make sure that you're looking at these things over multiple time frames, right? We're going to get into the indicators, but You have to, I always say, you have to understand what you're looking at, right? Now, if you want even a bigger trend to see where price is really at, because it's going to look the same no matter which time frame you select. If I choose a week, right, I can see that if this is a week, that means that this is 1 week. So this is price for the last 7 days. These two candles will be priced for the last 14 days. These three candles will be the price for the last 21 days, and so on and so forth. And we can see that's it's a little sketchy. We don't really see any type of pattern developing yet. So we can take our time frame down to the day, right? And then even on the day, we can see that we can find some support and resistance. We can see there's some cars in this lane, and we can see there's some cars in this lane. But we know that this is a barrier, right? You know where to put your support and resistance lines if you find a bunch of activity between two lines, right? So let's take our analysis back to the 4 hour, right? Because that's pretty practical. The reason why I like to analyze on the 4 hour is because I know that if I put in a trade, let's just say when I go to bed, or if I put in a trade at 10 p.m., in 8 hours or over the course of two candles, I can make profit because that's the analysis that I was looking at, right? So I have this candle highlighted right here because, and I put a buy signal here because this is a trade that I got into yesterday. I got into this trade for a buy. And if you follow me on Instagram at Money Mantra Cha, you will see that this trade actually hit the profit point that I selected, right? But how did I know it was going to hit that point, right? And it's simply because of support, resistance, and indicators, right? And knowing how to read those indicators, um, to make myself more profitable. So we just going to use this small section of the chart just to do our analysis. We have our support and resistance. I'm going to delete it and I'm going to put it back. And if you understand why I'm placing these lines where I'm placing these lines, just drop a 7 in the chat. But if you don't understand, just drop a question mark. So when you first get into the market, the first thing you want to do is set up your support and resistance, because this is going to give you your entries. Okay, so Kanisha says she doesn't understand. All right, so the market has a bunch of candles, right? It has the buy candles and it has the sell candles. So price can, hold on, I'm trying to delete everything. So price can either be going down. Like if I put a line right here, that's the area of resistance. Resistance is a point in the market where price didn't get any higher than that. The buyers couldn't push the price any higher. It hit a cap, and then price started to sell. So that's the area of resistance. And you know it's the area of resistance. Again, if we go to the car analogy, if you see the cars, these two cars, they drifting, they have the wicks, but then they came back down, right? And then if I put another line right here, this would be an area of support. And support is an area where price, the sellers can't get it to go any lower. So buyers start to push the price back up, right? So again, if this was the other side of the road and this was the car never drifted past that side. It came back and then the car stayed there, right? Until you see that wait, I need this line. Until you see that more areas were created down here, right? So does that make sense, Kadisha? Let me know. Okay. All right, awesome. So I'm going to put my lines back because again, we always want to start with support and resistance because I'm telling you, this is key into knowing if you're going to buy or sell, right? You want to see where you see the most activity. You want to put your lines there, and then you want to actually start to add your indicators. Now, this is just called a naked analysis. Right now, we're just doing a candlestick analysis. We're seeing where price was at, but we don't really have any technical indicators on our chart. Now, the technical indicators are going to tell us if what we're looking at is actually true, right? If when price gets back to this line, is it going to sell again? Right? Or is the car actually going to decide to switch lanes, right? Is it going to stay in the middle lane or is it going to decide to go in the left lane? And that's what the indicators are going to be to confirm in your analysis, right? Now, one thing I want to highlight is that when you put these lines on your chart, it's going to be corresponding to a number, right? And that number, depending on whether you're buying or selling, is going to be your entry point for your trade. So here, as you can see, that line corresponds with 1.1778. For example, this line corresponds with 1.20522. So wherever you place those lines on your chart is going to give you a price, right? But you can't just do anything with that information yet. You have to know, what am I going to do with that price? Am I going to buy at that price? Is price going to resist and not go any higher than this like it's done in the past? Or am I going to sell at that price? That's the whole thing you're trying to figure out. So the indicators that I like to use, and if you guys are taking notes, an indicator is a specific tool, right? That tells you one thing about the price. It's a specific tool that tells you one thing about the price. And you can use as many or as little as you want. But I only use three, and it's really been working wonders for me. So in addition to our support and resistance lines, where we can see, and I'm gonna circle it again, we can visually see those areas where price said, I don't want to go any higher than that, I'm going to sell. And how do we know? We don't see anything above it. We see it adjusting itself, we see it correcting itself, we do see it breaking structure here, right? But then it created a new pattern, right? So your job as a trader is just to follow the pattern, right? And to use your technical indicators to decide whether price is going to continue within that pattern, or if price is going to break structure and create a new level, right? So if that makes sense, drop a 7 in the chat. Because I promise you, once you understand the concept of support and resistance, and how much it plays into everything, you're going to be like, this is so easy, right? This is so easy. So let me clear this off the chart. All right, so now let's get into these indicators, right? Right now we're doing a technical analysis. And the technical analysis is just using indicators, right, that have been proven over years and years and years to actually give you signals as to when to enter and exit the market. So the first indicator that we're going to go over is the SAR, right? So I just unhid my SAR, and you should see these little blue dots that popped up on my screen. I'm gonna just make them a little bit bigger, just so we can really get a better idea. And I just like them to be purple. Y'all can do as you please. Right? Right? SARs are so nice. So here we go. So the parabolic SAR. Oh yeah, another thing to know about indicators is that indicators come in categories. So you can have an indicator that's telling you how strong is a trend, right? Is the market going to continue to buy? You could have an indicator that's telling you about how volatile is the market, how likely it is to switch. You can have indicators tell you when there's going to be a reversal, right? You have indicators that tell you about divergence, which also lets you know when to get in. So again, it's really all about building what works for you. Now, I like the SAR because it's a trend indicator. And a trend indicator just lets us know, is the market going to continue doing the same thing that it's currently doing, right? Is it going to continue to do the same thing that it's currently doing? Now, to use it is pretty simple, right? If you find that the candles are falling under the SAR, right, is letting you know that the market is going to be selling, right? It's going to continue to go down, right? Is letting you know that price is below average. This is not where it's been. In this example right here, let me just circle it. In this example right here, this is telling us that price was staying around 1.200 or $1.20, right? Price was staying around $1.20. Then we knew price was going to drop because we had the SARs on top of the candles, right? It's saying this is the trend. Pretend the SARs are the trend, and if the candles are below them, it's telling you that price is below the trend, right? So they said price is going to go under $1.20, and then price actually dropped. Price dropped to 119. Then price dropped to $1.18, right? But then it eventually went back up, because remember, the market has to always correct itself. Whether it's going to stay in the same lane or switch lanes is, again, up to your indicators to let you know. So in this trade example, In this trade example, if we were only going to use the areas of support and resistance, I can move this up actually. If we were only going to use the areas of support and resistance and the SAR, wait, let me move this down a little bit. I would have seen that. Well, I did see when I got into the market, right? There was a green candle and the SAR was below. Now, if the SAR is above, mean that the market is selling. The SAR is below, mean that the market is going to buy. So that was my first indication. I logged in. I said, oh, okay. I see a little green candle telling me that the buyers currently have some momentum in this market. Not only that, I see that my SAR is below the candle. So in my mind, I'm like, okay, I'm in my mind, I'm forming a bias towards getting into this market for a buy, right? I'm thinking about going long with this trade. It just makes sense. But I'm going to add another indicator that actually told me more about the price and why I made the decision to get into the trade. So this indicator that I just unhid is called Donchian channel, right? And it looks like another indicator that you guys may or may not be familiar with called the Bollinger Bands. And this indicator tells you a lot. It tells you so much stuff, and I just love it so much because it's so easy. I mean, once you start to use it correctly, you will see your profits, right? So with the Donchian channel, it consists of three lines, right? You have this thick top line, you have this orange line in the middle. Let me actually make it a little thicker. Right? You have this thick blue line, you have this thick blue line, and then you have this orange line. Now, I like the Donchian channels because it automatically highlights levels of support and resistance for you, right? If you see that the top is flat, it has to be flat. This is something that really changed the trading game for me. If it's flat, that's an automatic area of resistance for you, right? You know that price had a hard time staying at that level, right? If it's flat at the top, that could be an indication that the market is going to go for a sell, right? And if it's flat at the bottom, that could be an indication that the market is going to go for a buy. So let's just go back. What I like to do, and this is just a quick glance of back testing, right? Once you put your indicators on and you start to say, okay, that makes sense. Candles below the SAR, getting for a sell. Candles above the SAR, getting for a buy. Okay, Donchian channel, flat bottom buy, flat top sell. And then if you see both of those things, that is a confirmation, right? That you can go ahead and get into the trade depending on the way you're looking to go for a buy or for a sell. So let's just go back in the past a little bit and let's just see if we can find a perfect example of that, right? So here, for example, we have a flat, well, no, because the SAR isn't under. Let's find another example. Well, here's a good example. We have a flat top candle is red. We have the SAR above the candle. We have, all right, we have we have a straight line telling us that the market was going to go down because this is acting as resistance. As we can see, the candles, I could just circle it too. As we can see, the candles really had a hard time getting past this area of resistance, right? They really had a hard time switching lanes. They really wanted to stay in this lane. So every time it hit this zone, which was around this price, $1.23, the market was going to sell, right? So if we set up some support and resistance lines, which we already have, and you can adjust it to, if you see, once you add your Donchian channel there, you can just adjust your resistance line there, right? And you have two confirmations that if you would have got into this trade for a sell, we can visually look at it and see that's exactly what happened, right? The market actually sold, right? Based on those two indicators, if you would have got in, the market went down, and over the course of 6 days, you would have got about 280 pips, right? Depending on how you set your risk and reward, right? So that's just two things, right? So I'm going to just explain the last indicator, and then I'm going to get into the examples of the back tested theory where every single trade that I have highlighted in the chart, it hit its profits point, right? Based on confirming the three simple things that I'm teaching you right now, right? Now, this last indicator at the bottom is very popular Is very simple to use. Um, it's called the MACD, right? That's the short name for it, but the technical name for it is the moving average convergence divergence, right? That's a lot, so we just gonna say MACD, right? These things be having a lot of words. And this indicator is consists of a histogram, right? A histogram are these bars, and you don't have to know these terms, but you just have to know what they do. Like when you look at it, you need to be like, all right. So the histogram is telling you about momentum, right? If the sellers are selling, if you see that it's high and it's going up, it's like, okay, it's going to keep selling. Like the momentum for that is high. It's going to continue to sell. And vice versa. If you see that it's down, again, it's going to continue. Whatever it's doing, if it's at the top, it's going to continue to buy. If it's at the bottom, it's going to continue to sell. The MACD also consists of two lines. You have the MACD line, which is the blue line. Let me just double check. Yep, you have the MACD line, which is the blue line, and then you have the signal line, which is the orange line. Right? It's very, very, very simple. When, and this is just something to highlight about the MACD. Whenever you see the MACD cross, right? Whenever you see the MACD cross, that is a reversal, right? If the signal line, which is the blue line, crosses below, right? If the signal line crosses below the MACD line, that's telling you that the market is going to sell, right? The signal line is the blue line, the MACD line is the orange line. If the signal line crosses below the MACD line, is telling you that it's going to sell. And if we align it with what's happening at the top of our chart, right, we can actually see that's what happened, right? The market actually did sell. It sold from here to there, right? And depending on your risk, you would have still got 100 pips in about 24 hours, and that's really not bad, right? You literally had everything that you needed. Oh, another thing. Well, we're actually gonna have to do a part two to this class, y'all. This link is about to stop. However, I'm gonna just stop it now, and I'm going to just restart it. So come back for the second part of the lesson. We're gonna continue. We're gonna do a part two. If you guys are learning something so far, just drop some sevens in the chat, because this is a lot of information, but I want to make it as simple as possible. So I'm going to end this link now, and then I'm going to restart it. So I'll see you guys in about 30 seconds. Thank you for coming to the Money Mantra today.